Welcome out to Trading Justice 592. I'm with my brother Matt. This is Mark Justice, and we're going to talk a little bit of markets. We're going to talk Jackson Hole. It's happening this week, and I learned some things. I'm a student of history. I learned some things that have happened at Jackson Hole that we're going to discuss that I did not know before researching for this podcast. It is actually a pretty big event where some big monetary theory can be put forth. We're going to talk about the week that was in the market. That was the best week we had in the year, Matt. Best week of the year. Percentage gain, best week of the year, and the Goldilocks narrative that kind of fueled it. They talk about gold. Textbook technical breakout for the ages, some of the things on our agenda. But how are you doing today, brother?
Doing good. Excited to be here with you to record another pod and have a conversation on the week that was, but also kind of the week that's coming at us. And the week that's coming at us, we always talk about that's kind of our process in the podcast, right? We talk about the week that was, and we talk about the week that's coming at us. And the week that's coming at us is all about the central bank. It's Jackson Hole. It happens every August, and it's one of the more important moments where you can start to understand what the Fed is thinking about the here and now, but you can also start to understand what the Fed is thinking about the future as well. A lot of economic policy speeches, a lot of ideas. Everybody has an idea, right? Everybody's a genius in their own mind. They have these amazing ideas, and the way I've described it in the past, Mark, is I've had some of the most amazing, beautiful, just great ideas in my mind, and just when I go to talk to them about those ideas with people, they're like, wait a second, that might not be as great of an idea as you think. Sometimes we get that.
Isn't that true though? You verbalize the idea that you think is brilliant, and you can't quite find the words that make it sound as good as it was in your head.
And so you see a little bit of that at Jackson Hole as well, but Mark, you think back to the last 20 years of monetary policy, and when you think about quantitative easing of 2008, well, the early signs of quantitative easing were out of Japan, and then obviously in 2003, a speech out of Ben Bernanke. When you talk about the pain of inflation that was going to happen, well, at Jackson Hole in 2022, there was a speech talking about pain is coming. And so it's an important moment, and especially this year, Mark, because the years where you have changes in monetary policy, they become extremely important moments. For example, the most important moments at Jackson Hole in the last 20, 25 years are, in my estimation, 2003, laying out quantitative easing, 2008, 2020, and 2022. And those years all have some very, very important monetary policy changes in those years. And this year is one of those years where we are expecting the central bank to start alleviating the restrictive territory of the monetary policy. How far will they go? Where is their mind? How aggressive is that going to be? Where's their concern? Where's all the context? I always tell my kids, Mark, context is for kings. It's extremely...
Did you come up with that quote?
No, I did not, but I do love that quote.
That is a good one. I like that.
And I talk to my kids about it all the time. Context is for kings. You have to understand the context of the environment. And that's what, we talk about the central bank all the time. We talk about the Fed and monetary policy all the time. Its importance in the market is you don't even need to talk about it, because it's the number one impact of all financial markets is what is the central bank going to be doing. But we get so focused on the actual path of policy, and we get so focused on will they or will they not cut or cut interest rates, raise interest rates, or whatever the case they're doing. But we don't get into the context very often when it comes to the monetary policy decisions. Jackson Hole provides some of that context, and so I think it's an important moment, no doubt about that.
And that's what I learned in studying with you on this and doing some research, is the context they provide. If you are paying attention to the context, it provides frameworks for your trades, not for weeks, for months, for potentially years, especially when you have those monetary policy shifts. And we'll go over that. And we're not going to have time to talk about it in this podcast due to time, Matt, but I want to give you a shout out on discussing Elliott wave theory in the newsletter. We're going to have to do a podcast on this at some point before the year is out, because once again, I learned a lot, and I am no novice. I am not someone who is just, and I still learned a lot. The Elliott wave theory is not something that I have a ton of expertise, and I found your write up very detailed. And you're going to do a coach's show on this
Maybe not this Tuesday, but
coming up at some
yeah,
point.
sometime very, very soon. One of
So,
the
yeah, talk
things,
just high level, and you're only
yeah,
allowed 60 seconds because we got a podcast to do, and this
I
is the
won't even
big
take that
subject.
much. I won't even take that much. One of the things I try to do in the newsletter is both educate and apply. I like to apply the technical concepts that are happening in the market today, the importance of that analysis, but I also want to educate our community along the way. We believe in education, and in our newsletter, I strive to do both. I strive to teach in our newsletter, and I also strive to inform in our newsletter. And so I decided, because one of the things I'm tracking on the long term is the wave counting on the Nasdaq and the depth of the retracement during the corrective territory, and I described that in the newsletter through an Elliott wave lens. And so I took the current market analysis and I applied Elliott wave on the current market analysis, teaching Elliott wave through applying it on the current market analysis. And so if you're looking for application type concepts, I like to provide that in the newsletter. But if you're looking to increase your knowledge so that you can have that understanding, not about the context of this week, but in general, I love to do that as well, Mark.
All right. Yeah. And one other thing we talked about in the newsletter, you did a great job on that, by the way, was the Goldilocks environment that is setting up in this market. And that is something that we're going to spend a few minutes on here because it has application for the coming week. But Matt, we're just coming off the best week of the year. Percentage wise, we have rocketed V-shaped style off those lows from a couple weeks ago. Carry trade, that's yesterday's news. Goldilocks, today's news. And let me just give a little recap if you don't know what Goldilocks is in referring to economic terms. So, Goldilocks is an environment where economic growth is strong, but it's not so hot that you're worried about inflation reigniting.
Mm-hmm.
It's not slow that you're worried about growth worries that seemed like it was yesterday news, even though it was only a couple weeks ago. But it's an environment where things are all right, right? Inflation is moderating, economic growth is there, not too robust, but certainly not worried about growth scares. And Matt, I saw JP Morgan, I saw Goldman Sachs, I saw numerous financial analysts throwing out the Goldilocks narrative towards the end of the week based on the economic data that came out.
By the way, a week and a half ago, those same banks were increasing their recession probability for 2024. The banks are ridiculous right now. They're chasing recessionary probability based on
they're day
price
traders.
action. They're making recessionary calls based on intraday price action. It's absolutely insane. But outside of that, Mark, it's been a great reprieve in the market this week, and yeah, the market heard what they wanted to hear out of the data this week. There's no doubt about that, and it's been a fantastic recovery. But that's what it has been, is just a recovery. It took 3 days of price action for it to go down from 5,600 down to 5,200. It took 2 weeks of price action to go from 5,200 to 5,600. And so that's all we have seen is from 3 weeks ago labor market numbers until this week, a recovery. Now the question is, what transpires next in the marketplace? And to me, the most important aspect of this conversation is going to be the development of the next pattern in the marketplace, because in the newsletter this week, when I was talking about Elliott wave, one of the reasons I wanted to talk about Elliott wave theory was not because of Elliott wave theory, Mark, which I find people who talk about Elliott wave theory do not even understand any aspect of what it is. And it hurts my ears, honestly. It hurts my ears when I hear people talk about it, because they sit there and say, oh, Elliott wave theory doesn't work. And you're right. In terms of the 1,000% accuracy of Elliott wave theory, it doesn't work. But in terms of the analysis that created Elliott wave theory, that's the same type of analysis we use today. For example, in the ABC cycle in Elliott wave, let me just take a moment to just kind of highlight this, Mark. In the ABC cycle in Elliott wave, it starts with A, obviously, which starts with a deeper retracement against the weekly chart after a 5-wave count. We've already went through that. And so basically what I wanted to do was teach the concept of A, then B, according to Elliott Wave. And in A, if you see a deeper pullback, which we have certainly seen over the course of the last month and a half in the marketplace, as you see that deeper pullback, that establishes the market correction. Then what happens in B, again, the newsletter, I talk about this quite a bit, and I actually did a video on it. I'll be teaching this in a coach's show coming up at Tackle Training fairly soon. But in B, the depth of the retracement is extremely important, Mark. And that's what we saw this week, is we saw this retracement, a bearish retracement in the short term against the long-term analysis. So in the short term, you got a bearish downtrend, lower lows, lower highs. In the long term, you got a bullish uptrend. We're trying to track the differences between those two time frames. And so as the market goes up deeper in its retracement, and it comes to a level, and that level would be 61% on the Fibonacci retracement level. If it gets above that level, it's no longer a bearish retracement, and that's extremely important. So however you describe it, if you describe it in the way of ABC cycle, some people might be like, oh, Elliott Wave, oh, that's just ridiculous. If you describe it in terms of deeper bearish retracement plus bear stop out analysis with the momentum of the bulls, then people are like, oh my goodness, that's amazing analysis. It's the same analysis, just described in a different way. But the point is, in this retracement we have seen, you retrace so far up that you no longer have a lower level of resistance. And because the bearish retracement went so far up equal to the previous pivot, you no longer have a bearish trend in any capacity. And that's the importance of this week's price action, is the retracement was successful enough that it blasted through any potential bearish pattern.
Yeah, no, and now becomes the next setup, right?
Yeah.
Now becomes the next setup and what we're going to be keenly focused on. And let's go to Forex Factory, if you don't mind, Matt, because it helps talk about what fueled this price action, and then gives us the setup for the coming week, which then transitions into Jackson Hole. But Matt, when I was following the price action this week, like understanding the narratives of the market, like even if you are not going to become the biggest macro human being on the place on planet Earth, understanding the basic narratives of the market help price action make sense. So when somebody at the end of the week says, we just had the biggest week of the year, someone might be like, oh my gosh, what happened? Well, you had one narrative shift into another. When those things happen, it tends to cause really dramatic price action one way or another. And so you came into this week, Matt, with worries of slowing economic growth. You had worries of labor market. And when I was following the macro data as it came in this week, it was like, well, bulls win, bulls win, bulls win, bulls win. Right. And as bulls win and as narrative shift, and all of a sudden those banks are adjusting their recessionary odds and be like, oh, well, maybe no, well, you see price in the coming off this deeper retracement, just hold. Matt, when you were looking at that, can I give us a review and give us your thoughts on the economic data as it was coming out this week?
Yeah, Mark, you're absolutely right. Understanding the current themes in the market is really important, right? You had from the central bank on, remember the big drop in price we had following the central bank, right? So you had two things occur in that moment that really spooked the market. Number one, you had the central bank, who everybody was, I don't want to say everybody, but most people were expecting the central bank to be a little bit more clear on what they were going to be doing in September. Now, we'll probably see that out of the central bank this week at Jackson Hole. And maybe that's why they held off, was they have some speeches and some updates planned for Jackson Hole. Maybe that's why they held off on the clarification from a couple weeks ago. But without that clarification, that put the entire market on data dependency, a data watch, right? Which means we're very sensitive to the incoming data because of the central bank told us to be sensitive to the incoming data, because the central bank said they did not have the data necessary to support whether or not they were going to start cutting in September. And so the central bank put us on data dependency and data watch, which put inflationary reports a little bit more sensitive to the marketplace. They also ensured.
Yeah, and let me just list
Yeah.
point it. When the Fed says we might need to see more progress on inflation, when they say that over and over, guess what algos are going to do?
They're very sensitive.
They're going to react at a quicker rate to price action on inflation.
100%. And so two things occur in that week, Mark. One, you did not get clarification on the path policy, which honestly, I still don't even know what Jay Powell was thinking going into that meeting. It was fairly clear. There's not really a debate by people whether they're going to do something in September, and it's only the central bank that seemingly was a little bit confused on what they were going to do in September. And so when everybody else is like, "Oh, I thought we already knew what you were going to do in September, and now we don't know what you're going to do in September," that obviously is going to get a little bit of a negative reaction. And then on Thursday of that week, you had initial claims come in with a big bump up, and you also had the labor market have one of its worst labor market reports it's had year to date. And so that week was really, really important because it put the two themes that really kind of drove the recovery this week is the one, path of policy wasn't clarified, data dependency out of the inflationary reports, and then number two, you had some really tough economic data that came out on that Thursday and Friday right in the same moment where the market was frustrated, confused, concerned over the path of policy.
And then you had the carry trade, and then it just became a
yes.
It was, proverbial, just like everything hit at once.
It was
like,
3 days of a lot of just negative news. Well, the polar opposite of that has occurred over the last week and a half, Mark. First of all, the carry trade, we need to understand something about the carry trade. The carry trade is a trade. When it gets unwound, it's gone. It's not part of that equation again. Does that make sense? Like that's a singular moment in time. That's not something that extends over time. And so once that trade got alleviated, don't get me wrong, we're still concerned over the Japanese raising rates in general, but they've kind of came off that language. And so Japan kind of threw in the white towel regarding, raising interest rates. The Japanese yen got unwound. And so that's kind of not currently part of the immediate concern right now. So that got alleviated in the last week and a half. The second concern you had was the path of policy. Well, Mark, just this week you were talking about that economic data that came out. Well, on the PPI report, it came out at 0.1. Expectation was 0.2. When you're looking at the overall, trend from a PPI perspective, you're not going to get too concerned over PPI at 0 to 0.1, 0.2% on the month-over-month situation. And that's kind of where we're averaging right now, is right around that 0.1. And so PPI report, not too much concern in pipeline inflation right now. The consumer headline inflation is the CPI report. That came out on Wednesday of this week. Now, the month-over-month numbers was not necessarily a reprieve. It came in at 0.2. Expectation was 0.2. And so that was really kind of where we were expecting, and not a lot of fireworks there. But the year-over-year numbers came in underneath the 3%. They came in at 2.9% year-over-year, which is a really good reprieve from a headline number. And when you're looking at the bulk, and a lot of that headline number is a lot in shelter, quite frankly. Like 80% of the inflationary rate that we are seeing right now is on the shelter side of the equation. And if you want that to be impacted, lowering the interest rate might actually increase some of that supply into the marketplace. And so it's one of those situations where the data from just a raw number perspective was not that impressive. But in the context, once again, context is for kings, in the context of the conversation what the central bank said 2 weeks ago, it really alleviated that concern on the data dependency side. And then you had economic concern out of the labor that same week. Well, economically this week, you got out of the labor, you got a pretty good number out of initial claims, 227 versus the 236. It's been averaging above 230, 240 over the course of the last few weeks, so that's a good little reprieve. And then a lot of concern on the consumer recently. and you got a really good double data point on Thursday out of retail sales with a big beat on retail sales, 1% against 0.4%. And then you had a Walmart report that came out, beat against expectation, and they raised third quarter guidance as well. And so when the Fed tells the market to be data dependency, let's don't get too surprised when we see volatility.
I mean, you think about it. I mean, just like understanding this point, the Fed says we're going to be data dependent 2 weeks ago. We have negative data. Algos react severely to that. We have and then people start worrying that the Fed's behind.
And then you have positive data, and the Fed,
and then we have positive. Algos are going to react positive to that. And basically,
Mark, real quick, and yet in that 3 week stretch that we see the big drop, big recovery, right? Has really anything changed economically in that big 3 week stretch?
No, of course not.
So what was the point of all of that? The point is Jay Powell made a mistake on the messaging, and I cannot get off that. We would not have seen the drop in price. We would not have seen the recovery.
That's a great point, because had Jay Powell said this is what we're doing, i.e. the phrase we use at Tackle Trading is the path of policy, the path of monetary policy. If they clarify that, algos aren't dramatically reacting to every freaking data point that comes out, which is the environment we have.
I think Jay Powell needs to be criticized heavily on the messaging side of the equation. The volatility is due to the messed up messaging, and I just don't get it, because he keeps making the same mistake over and over, and he's so scared to make a policy mistake in the sense of the size of the transitory problem of 2001, that he doesn't dare have the courage of his conviction to actually believe in his own opinion in a public way. And I get it. It's been a difficult environment. But if you can't be that, you can't be the head of the Central Bank of the United States, which is one of the most important and powerful positions in the entire world.
Well, let's talk about the setup coming into this week. Outside, all due respect to Palo Alto and Lowe's, and a couple of earnings reports, we don't have anything on Monday. We don't have anything on Tuesday. Nobody is going to care about the Fed minutes on Wednesday when Jackson Hole is 48 hours away. Nobody's going to care about the Fed minutes. And then we have the setup. We have a little bit of economic data. None of the big major retail sales unemployment report, but something. But then we have Jackson Hole. Matt, we are extended on a technical perspective. This is one of those situations where some sort of neutrality, high base formation, slight pullback, slight move up.
You're reading my head right now.
Would be very based on the news flow, right? Because you want to go look at the big days. Why did we have small movement on this past Monday? Why did we have small movement in markets this past Friday? It's because there were no major economic data points to feed off of. Right? And that's what algos are feeding off right now. Well, you got nothing on Monday, nothing on Tuesday, nothing on Wednesday, a little bit on Thursday, heading into Friday, and Jay Powell speaks at 30 minutes after the market opens on Friday. You're going to have a technical formation most likely heading into that speech, aren't you?
Yeah, it's kind of where my head's at as well right now. When you are looking at the technical side, it kind of paints itself a little bit, Mark. Early in the week, right? Early in the week, you don't really have anything on Monday and Tuesday. Just not a lot of data on Monday and Tuesday. You also have seen a sizable move over the course of the last... It's crazy because we're about at the exact same price we were at the end of July right now. After that big drop in price and the big recovery. You've had some really aggressive price movements. The market, even though it really hasn't done anything since the end of July, big down, big up, kind of recovered. The market's a little bit exhausted. And maybe I'm projecting a little bit there, but it does feel like the traders are a little bit exhausted from all of the information, the speed of the market, the news over the course of the last couple of weeks. It's been a wild ride. Well, Mark, you're going into an environment where on Monday you don't expect a whole lot of price movement, right? You're just not expecting a lot. So on Monday, let's say we get that type of number, and then so we get a doji on Monday, and then you get a doji on Tuesday because, again, you don't have that much information. On Wednesday, you start to get more information. You get the Fed minutes. Thursday, you get PMI numbers, and
it writes itself this week.
And you could probably see some wick analysis, but bodies probably stabilize. Mark, to me, the backdrop of the market this week: do we get a high base, and do we get a high base breakout on Friday with the catalysts of Jay Powell clarifying a lot of the confusion out of the market, because they only got a couple more weeks between at that point and the monetary decision of September. And so a high base, a little bit of a shallow flag, a technical conversation where we're alleviating the slight overextended condition. Secondary pattern gets developed in the market this week going into a breakout with the Fed. I don't want to call that base case, because you never know what Jay Powell's going to say, and you never know what the market's going to respond to.
Yeah, he could totally.
But that's the setup you want to see.
That is exactly the setup. And Thursday is the wild card for me, because algos that have been feeding on economic data, you're going to starve them for 3 days, right? You're going to starve them for 3 days, and then they're going to get a little bit Thursday morning. So Thursday is a little bit of a wild card of what the technical formation might look at. But Matt, if you have some version, shallow pullback, high base, some basic thing, Jay Powell comes out and delivers monetary message, I'm hitting bullish exposure, and I'm planning out, and I'm going to hit it probably pretty hard on Friday, because the setup's going to be there, assuming the Goldilocks narrative, right, that is permeating the market is still there.
And again, Goldilocks in the sense of the data that came in this week was all seen as positive regarding the 3 themes of concern we got in the market, right?
But it's not.
The Fed will navigate that economically. Goldilocks soft landing is a different conversation.
Yeah, so that technical, and on the Traders Lounge, pro members will join us. We'll break that down every day. We'll also, on our tackle today that we put out for everybody, pro member, non-pro member, we put that out on YouTube on the Tackle Trading channel. We will detail this technical conversation during the course of the week.
It's just aligning itself to again, we don't know what Powell's going to say on Friday. We don't know how the market is going to respond to it. But the market is setting up technically right in a week where you would expect a little bit of consolidation given the data.
This story writes itself.
It's setting up. Now is the Fed gonna throw a bunch of cold water on our potential bullish parade here? Maybe we'll have to wait and see that. But it is setting up for a potential secondary pattern going into a potential catalyst, and that's a pretty good situation to be in when you can get that secondary pattern right in the same scenario where you can get a catalyst. So the market is participating in that. We'll see if we can get that conclusion this week.
Yeah, I want to get to Jackson Hole here in a second, but I do want to spend a minute on gold. Normally, I would bypass gold as we get into the beat of the material. When you have, and we talk all the time from a fundamental perspective. If this is your first time listening to the Trading Justice podcast, then you may not know how we've been pounding the table for gold for years and years and years on this podcast. And we oftentimes ignore the technicals because technicals are secondary on gold. But man, this one's textbook. Higher lows heading into a breakout, month-long, 5-week consolidation. I mean, this thing is a textbook technical pattern.
And the thing about it is, Mark, the market's recovering off that drop in price, and it recovered very aggressively on some minor beats on the economic side of the equation. You would expect, with the market rallying the way it did, for gold to not get the bid it did, but it did nonetheless. And I'll just say it for the 14th billionth time. In this environment, investors aren't selling gold. It's just not happening.
They're had 40 to 50 excuses in 2024.
They're not doing it. Everything we talk about economically and how the impact on the market is not a real conversation on the economic impact of Americans in general and people around the world. The economic conversation in the market is pertaining to the marketplace itself. Gold has been and will be sniffing things out economically for a long time here, in my estimation. You still have central banks hoarding, you've got governments hoarding, and you got investors that will not sell their gold positions, regardless of the data that comes out. long-term investors know exactly what I'm talking about regarding the debt and the inflation. Yeah, we're talking about a slight reprieve on the inflationary side, and that is good enough for the marketplace. Is that good enough for you owning dollars against inflation for the next 30 years at a 2.5 to 3% scale, real scale? No, it is not. Gold will protect that. Gold is the number one protection asset class in the entire marketplace. There is a plethora of reasons to own gold against market economic chaos. We talked about that the last couple of weeks. So no, it's we got a lot of confidence in gold. We were in the coaches show this past week and I had about 45 of our students there in that coaches show this week, Mark. And I asked a question: what's your most confidence you have of any single instrument in the marketplace? And of the 40 people that were there, I would say 75% of them said gold. And then probably 10% said Bitcoin. There was a couple other, individual stocks, but for the most part, it was gold or Bitcoin.
Well, that's my answer. I answer them in tandem. When you choose me to pick one, I'll be like anti-fiat. I'll pick gold, Bitcoin.
See, I still believe gold is the inflation.
You're such an oldie, schmoldy, traditional.
Whatever. Yeah, listen.
Well, all I know is gold. Listen, I can tell you price action in 2024, Bitcoin's had a good year, but the consistency of price action would let me know that investors say gold.
1,000% on board the Bitcoin freight train for anti-fiat plays. Like I'm right there with you guys. Like I'm cheering you on. I'm excited for you, but I am a gold guy, and I'll just never believe that the digital currency of Bitcoin is the same degree of inflationary protection, currency protection, as gold has been for the thousands of years gold has been that. And again, I'm not anti-Bitcoin in that conversation, not in any capacity. Bitcoin, same team. I've said it for years. But to me, I think Bitcoin is a wonderful anti-fiat play. You know my opinion, Chucky, and I think a lot of the listeners know my opinion of the fiat currency model. I've done extensive podcast on kind of what I expect to play out over the next 50 years in the fiat currency model. I think Bitcoin not only deserves a place in that conversation, it has a much needed place in that conversation on the anti-fiat side of the equation. But is it an inflationary protection asset class the same way that gold has been? I think you can put it into inflationary protection. I think you can put it into the package of asset classes that are inflationary protection. But Mark, I think you can generally describe the entire stock market as anti-inflation or
sure, right.
So, like, is Bitcoin that? Yeah, it is that in the sense of the stock market is that. Alternative asset classes are that, but it's not gold. It's not gold, and it shouldn't, and it's never going to be gold, and that's okay because gold's the gold standard for a reason.
Yeah, listen, had to talk about gold as we head into Jackson Hole. Let's get talking.
By the way, on gold.
It's just, listen, you don't get textbook technical patterns all the time, and this has been one on gold. It's been beautiful. It's been one that you'd teach off of. That's how pretty it is heading into the week. On
the final conclusion of it, yes, there was some wickety-wick nonsense due to the volatility. But more than anything, very impressed by gold.
Absolutely. Now, are we going to be impressed with Jackson Hole? Let's talk about Jackson Hole. Let's get into our feature subject for a few minutes. The Fed, once a year since the year 1981, come to a little place called Jackson Hole. And it's not just the Fed. The Jackson Hole, which is in Wyoming, if you don't know where Jackson Hole is, I live in Utah. Jackson Hole is just a 2.5 3 hour drive that I've made several times. Beautiful this time of year, it's absolutely nice gorgeous. It's an absolute gorgeous. Now you don't want to maybe head there in December unless you're a skier or whatever. But
no, you don't want to get stranded on those roads. No,
I have literally driven to Jackson Hole. When the Fed was meeting, just to hang out in the ambience of it all, But it's not just the Fed. It is central bankers around the world.
It's the Davos for the West.
Yes, it is. This is where central bankers come. This is where they collude. This is where they come up with, some of the bigger monetary policy shifts we've seen. We'll talk about a few of them here in a second. Been going on since Volcker days, about 45 years now. Typically occurs about this time of year, right? It doesn't necessarily need to be the third or the fourth, but it's about this time of year because of the weather. I have no doubt. Like it's not.
They don't do it in December.
Yeah, it's not a coincidence, right? They do it because this is great time,
August
right?
in Jackson Hole, Wyoming, Utah. August in the Mountain West region is truly beautiful.
And the thing about it is something to realize that Jay Powell is going to give a speech at 10 a.m. Eastern, 30 minutes after the market opens on Friday. But this is not like a Fed meeting where there's a policy announcement and then a speech with a question. There are speeches and meetings and forums that go on for multiple days.
It's a conference is what it is.
Yeah, I mean, so this is not just a release an announcement and then here's our Q&A. No.
No, you have bankers at this meeting. You got corporate bigwigs at this meeting. You got government shills at this meeting. You got central bankers from around the world at this meeting. It's the Davos of elitism for America.
Yeah, and so you're going to have like Q&A from reporters at different times over 3 days. You're going to have forums. You're going to have speeches by other individuals. The Jay Powell speech, well, just happens to happen 30 minutes after the market opens on Friday. And that's not a coincidence.
I wonder about that timing there, Jay.
Yeah, that's not a coincidence, right? Here is, we want to.
Let me ask you a question.
Yeah.
If Powell was going to deliver the 2022 version of the "Pain is Coming" speech, right? That was a fascinating 2022 conversation. I don't think he would put it at 10 a.m. this go around.
Not unless he wanted pain to come.
I think he would do it at like 4 o'clock.
Yeah. And so just kind of understand, if you're new to like the Fed world and central bank world, just to understand what this event is. It's not a normal Fed meeting. It is much bigger than that, to be honest with you, because of some of the shifting policy things that can occur. I like this quote here that, our viewers, if you're listening to it, I'll just read it verbatim for you. The Jackson Hole meeting is a critical event where global economic policies are often signaled, influencing markets worldwide. And I think
that's a Matt Justice quote, by the way.
Yes. Sure. I think this is like, if you were to take away one thing from, I listened to a podcast, they were talking about Jackson Hole. And if you were to take away one thing, is that this is where global monetary policies are often signaled to the world, right? Like, because central banks don't act in silos.
They don't act independently regardless of what they say.
They don't, like the European, the Great Britain, the Australian, these are not independent entities that just, we're going to go decide to do whatever we want.
They're owned and operated by the same entities.
So they're going to come together, and when they want to make major collective shifts and signal that to the world, Jackson Hole is oftentimes that event. Matt, why is that the case? Like, just out of curiosity, do you think it's just kind of happened that way where like because people understand the importance of Jackson Hole itself, or is it just like, well, we need a place to do that at? Jackson Hole?
Listen, it's the Kansas City Fed that chooses Jackson Hole. So it was the Kansas City Fed. Remember, there's 12 there's 12 regional banks around the United States. So the Kansas City Fed is the one who in 1981 decided to start the conference known as Jackson Hole. They've been doing it since 1981. If you're sitting in Kansas City and you're thinking about the regions of the Midwest and the Upper Mountain West, and you're trying to select an area to go to, the mountain regions of the Mountain West are really, really gorgeous, and there are a few different places you could select in August in the Mountain West regions to have a nice little environment to bring the elites around the world to come in and hang out in. And Jackson Hole is just a beautiful place. But outside of that, there's not a different reason other than the geography of the situation.
Yeah,
I'm sure if the New York Fed, if this was a New York Fed thing, you probably have it in New York. But it was a Kansas City Fed thing.
Well, somebody loves those mountains.
I guarantee. I love those mountains.
but there have been, okay, so this started in 1981, right?
Mm.
And it has grown in importance, in the decades that have followed. And there have been, like I said, if you take one thing away, if you're new to central bank, that this is a place where major policy shifts are often signaled. And we've had a few of those in recent decades. 2003, and this is where I myself got caught up on a little history of Jackson Hole, as I was researching this with Matt. But in 2003, Ben Bernanke delivered a speech where he discussed Japan's unconventional monetary policies.
Hmm.
Matt, what was this, and why was it so important in the
Well,
years and years and years that followed?
the 2003 speech was one of the most important speeches in central bank history, given the fact that it set the stage for the future of all monetary policy. You can't tell the quantitative easing in the speech of 2003 without talking about Japan. Obviously, I'm not going to go through the old history of 1989 till 2003 of what happened in Japan from a monetary perspective, but it was in the country of Japan that you first had the idea of modern monetary theory get posted, and then it was discussed multiple times. It's been discussed, modern monetary theory, over the last 20 years at Davos, at Jackson Hole, many times. But in 2003, Ben Bernanke, who gave a speech regarding modern monetary theory and the utilization of quantitative easing and utilizing zero interest rates, such as the Bank of Japan had done in Japan for years and years and years. And that was the first time that we saw the quantitative easing ZERP type monetary philosophies be discussed in America. And that was in 2003. And again, that set the stage, that policy statement in 2003, because they were just coming through the 2001, 2002 dot-com crisis that sent the market spiraling down. Obviously, economically, it was a really difficult situation, and they were looking at the Bank of Japan and what the Bank of Japan had done in these types of moments, and they started arguing at this point to start using some of the Bank of Japan's monetary tools, such as ZERP, which is known as zero interest
And
rate
very
policy,
unconventional
and QE.
tools. Like compared to
They're about as unconventional because they had never been used in the history of monetary policy, quantitative easing as well as ZERP. It was just a Japanese thing. But then again, when you go through crisis, oftentimes we look at case studies out there in the world. Okay, what did they do to come through that? That's what Ben Bernanke was doing, and he gave a quote. He said, "In this new environment, traditional monetary policy tools may lose effectiveness." This was the first time where you really started seeing the central bank shift away from the Volcker monetary policy, the Alan Greenspan monetary policy, where they're like, no, the 2001 crisis, the technological environment, traditional monetary policy tools of just increasing or lowering interest rates, they may not have the same effectiveness as they once did. And even though I disagree with Ben Bernanke's utilization of quantitative easing in the degree that he did, I do agree with this quote in the sense of you have to adjust your monetary tools to meet the moment. I just would not have used quantitative easing to the level that they did.
Yeah, well, listen, as we're going to find out shortly, they did decide to use quantitative easing on the style, and they would announce, once again, at Jackson Hole a few years later, case of 2008 financial crisis. Remember, this is August. Things would get uglier the rest of the year, but we were already deep into worries, crisis.
Yeah.
I do not think Lehman had happened yet. I think Lehman was a September.
No, Lehman. The way it worked was you had. Okay, just can I give you a little bit of a summary here, because I do know this saga fairly well on the 2008 crisis. So if you think about the 2008 crisis, you got to go back in time, some time, obviously, but it started in April of that year, Mark, when the market had already reversed. The market was down about 7% from the highs, and Bear Stearns went belly up in April of that year. And that sent the market down pretty aggressively in the short term, but not too crazy. It stabilized in June and July of that year, and as we were going into August of that year, okay, so we're going into August of that year, that's when Jay Powell gave his speech on the utilization of quantitative easing, but he stopped short of announcing they were going to do it. And so in 2008, it first starts with February of 2008. Ben Bernanke gives a speech in front of Congress, a testimony in front of Congress, saying that the subprime meltdown is perfectly fine. Automobile sector has started to recover. 2 months later, we see Bear Stearns go belly up. 4 months later, we see Lehman Brothers go belly up. A couple months after that, they embrace quantitative easing for the first time, zero interest rate policy a few months later, and obviously all the bailouts and everything along those lines. And so when you actually think about that '08 situation, it starts with his speech in February of that year, which basically broke support. Then you had Bear Stearns of that year form a kiss of death. Then you had that speech form basically a consolidation pattern. And then, Mark, in September, when Lehman Brothers was announced, that's when you saw the violation of 1,200 in the market. That's when you saw the volatility just I've never seen anything like it outside of the pandemic. That 2 month stretch, I don't even want to say that 2 month stretch. That 2.5, 3 week stretch was historical, and it really did set the stage in 2008 in August when Jay Powell, not Jay Powell, but Ben Bernanke gave his speech on the utilization of quantitative easing, and it did mark the beginning of the Fed using QE for the first time. So 2003, Ben Bernanke sets the stage for QE. 2008. The stage has already been set.
Yeah, he says it's coming.
And they have the tool necessary to combat it.
Yeah, I know. So once again, we have a major event, a major policy shift, and understanding QE. Well, that was the trade for the next decade.
Well, quite frankly, QE is going to be with us as long as we have, as long as we are in the fiat currency model. The markets are going to embrace QE. The Fed has already done it. It's here to stay. I don't like it, but that's one of those things you can't get away from once you've started it. So it's
and then coming off another crisis on the pandemic in 2020. So to set the stage here, right, we have the pandemic in 2020, and then we have the injection of unprecedented stimulus, both from a monetary standpoint and a fiscal standpoint. Money is flowing into the system, few people might have known that inflation was going to become an issue. And Jay Powell,
including Jay Powell,
which from this speech, he knew inflation was going to be an issue.
Of course he did. We all did.
Because what did he say in the 2020 Jackson Hole?
He literally changed the inflationary target in 2020. And so the 2020 speech was really, really important because obviously we're going through the pandemic. We've seen the markets be shut down, the economy shut down. It's crazy volatile out there, but we're on the recovering stage of the economy. We just saw that first, I think it was actually the second act that had came into the market. The first one was like $2,000. I mean, we were raining helicopter checks in 2020. So had a couple stimuluses. It was pretty apparently obvious to anybody with the brain, I would say, knew inflation was coming. They absolutely knew inflation was coming because you cannot stimulate the market to the level. And again, people might be like, well, Matt, they do this all the time. Why 2020? Because you never had the combination of both the central bank from a monetary perspective and the government from a fiscal perspective. And this is where people get inflation so confused. They just focus on the government fiscally when it's really the monetary side that's important. But in 2020, you had the fiscal stimulus plus the monetary stimulus, and that was just enough to spark inflation that we had not had to deal with in the previous 20 years in the marketplace. And so it was interesting because we knew inflation was coming, and the Fed didn't want to do anything about it because the economy was still on pins and needles in the pandemic. And again, I criticize Jay Powell a lot, and I criticize the central bank a lot, and I criticize the government a lot, but and rightly so. But 2020 was a unique year, and the context of 2020 matters as well. Things were legitimately scary in 2020 economically and from an inflationary perspective. And so Jay Powell makes a decision here that I felt was extremely important, that set the stage for the transitory mistake and set the stage for the inflation that all
Matt,
of us have been dealing with.
You read this, and it was almost like set the stage for the transitory choice.
Mark, I do believe they knew, and I do believe I believe they lied on transitory to America.
And this speech, once again, a major thing saying, listen, we're essentially common just listening to us like, this speech basically said, we're going to ignore inflation for a while.
And again, it's because this speech was the change of the targeting of inflation from 2% to a loose 2.5%. So they target 2%, but in 2020 they changed that to target 2.5%, and they changed it to make sure it's an average over time instead of a more specific target, allowing them to open up the floodgates of monetary policy to help with the pandemic. Again, understand the context. But anytime you change your inflationary target, bad things happen, Mark. It just does. There's a lot of evidence historically on that. And so it was a mistake in the moment. That mistake in 2020 set the stage for the biggest problems of their 2022 speech, which was their will be pain speech. Because again, 2020 set the stage for them to adjust their inflationary target to 2.5, a loose 2.5. In 2021, they were arguing the entire time that the inflation we were seeing in the early stages of the pandemic recovery was based on the supply chain. So it was all supply chain. It's all supply chain. Nothing to do with the money they put into the market. All supply chain. All supply chain. Well, when that was obviously false, and they knew it was false, in 2021, the transitory language was being applied from a government and a monetary side of the equation. Well, in 2022, that set the stage for there will be pain speech, as Jay Powell laid out we were wrong on transitory, and we're going to have to be aggressive on the monetary side of the equation to offset the problems associated with 2020 of inflation targeting, the adjustment to inflation targeting, and then in 2021 the transitory language that was just a nightmarish, silly, cartoonish way of describing the post-pandemic inflationary situation. So in 2022, he gives a speech where he says, there will be pain. And once he said there will be pain, the market decided to price in that pain. What's your thoughts?
Oh, well, there was. I mean, like the markets had rallied in July and had started to wobble a little bit of 2022. And Jay Powell, what struck me, and I think struck a lot of market participants in this, because that was a very long 2 months that followed into the October lows. A lot of violent price action just about everywhere. His remarks were concise and short. Oftentimes, Jackson Hole speeches will be very lengthy, talking about all kinds of stuff. The 2022 speech was
like 8 minutes.
8 minutes, which is incredibly short for a Jackson Hole speech. He wanted to make sure that the message was delivered, that there wasn't a lot of other things.
He didn't want the market to to misinterpret anything. Guys, we're raising aggressive. It's going to be pain. Market priced in 600 points of movement to the downside.
And this speech, like, because if coming
this was
into
also the moment, Mark, if you'll remember, the reversal against the 200-day moving average that I was screaming against everybody else, calling for the end of the world. Everybody else saying that the market was going to go through the ultimate bear, and it was me and a couple other people, because there was not a lot of people out there, and I was the one saying, no, this is over. It's priced in. It's now starting to a different thing. Mark, some of that was technically, others was, quite frankly, my understanding of Jay Powell and the central bank.
Yeah, no, and then we've transitioned to a new phase. But Matt, we got a speech coming up here in a couple days. Will he signal? There is very little excuse to not make the path of monetary policy clear. For crying out loud, that's what Jackson Hole often is. And that is my question to you, because, okay, when we painted at the start of the podcast, listen, you come up, Goldilocks, Jay Powell delivers okay, this is path of policies. Algo, stop reacting to every negative newsprint and positive like it is the end all be all, right? Because here's the path of policy. But what if he doesn't?
Well, if he doesn't clarify, Mark, we got 3 weeks in front of this, in front of September. They better be. What are they going to do? We're still waiting on data for September. If they do,
that will just be kind of silly, won't it?
If they do that, the market will puke up the gains it's had in the last week and a half, and we'll talk about a double bottom. I don't see that because, again, I think Jay Powell's a little bit cowardly. I do. I absolutely do. There's no doubt about that. I
could end the podcast there, by the way. Like, Jay Powell's a little bit of cowardly. Oh, it's been a great podcast.
I don't know. If he's not clear, what are you waiting on? What data are you waiting on? What do you got? You got a labor print and one PPI.
And here's the thing, and here would be the hypocrisy and the contradiction, because they say, well, we're not going to rely on any one data point. Well, if that's the case, then you know.
Which is what they said. So again, you're too tight against the September meeting. You got to be clear. You are changing your monetary policy. You are absolutely doing that. We all know it. You've been projecting it for a long, long time. If you're not clear in this speech like you were clear in the 2022 speech, like that was the 2022 speech was one of his best speeches he's ever given. Don't get me wrong. I didn't love the outcome of that 2022 speach. 8 minutes, very direct, no fluff.
But you knew exactly where the central bank was. You knew exactly.
Whatever the case, be clear. That's what my advice to Jay Powell this week is. Be clear on your messaging. More than anything, be clear on your messaging and stop trying to paint the middle of everything. Give us the real information. We know you're cutting. Everybody knows you're cutting. Let's have the real conversation on the path of policy so that the market doesn't have to be overreacting to every single point of data regarding the monetary side, because there's other things that drive the market, not just the monetary side. So I would just say the number one thing to Powell this week is be clear on the messaging side of the equation. You cannot maintain your data dependency the same way you have in this pause. You've been in your pause for well over a year now. You've had more than enough data to have an opinion. Give us your opinion. It is absolutely ridiculous that if he sits there and tries to be the middleman again, no, this is not a moment for consensus building, so that you can get 12
and it would be very strange. And this is one of the reasons we want to talk about Jackson Hole, besides this big event, teach and do all those things. It would be very strange to give that type of speech at this event, right? That is like a standard. Hey, we're meeting at Stanford for a. Like
I
we're
would
meeting a
be
stand.
shocked on a data dependency speech. I would be disgusted, grotesque. I would annihilate Powell as much as I can in the written and the verbal
It just would
content
be weird
at
at
tackle
Jackson
trading.
Hole for that
I'm
type of
sorry,
speech.
it's nonsense, Mark. It cannot occur because you have already signaled at 6 out of the 7 major central banks are already starting to lower rates. You cannot have that speech in 2024 at Jackson Hole to give us a 10-minute data-driven, data dependency. We don't know what we're doing. We need more
Because Matt,
time. I'm sorry, you got Europe already cutting. London's going to cut. Canada's cutting. Japan's hiking. But outside of that, every other central bank is cutting. You cannot have a data dependency speech when central banks around the world have already started cutting,
it'd be weird.
and we anticipate Jay Powell to start cutting in literally 3 weeks from now. And so no, he's got to be clear, Mark. He's got to be clear, and he has to know that. After the market puked up his words 3 weeks ago, he has to know that. This is a moment for Jay Powell.
Yeah.
Listen, you know me. I think transitory, and I think it's already
What's
there.
funny is he's getting a do-over. The market's like, we're going to go down, we're going to go up, we're going to be about the same level as your last speech. Here's like, a do-over.
Okay, can I do it this time? Can I do it this time? I don't think Powell's like going into this speech saying, I need to make sure the market.
But Matt,
likes
I
me
mean, the one thing is Jay Powell is one of the most stubborn human beings in the.
Are you sure? Are you sure?
He's pretty stubborn.
Are you sure? Are you sure?
He doesn't care about market.
Are you sure it's stubbornness and not cowardice?
Yeah, I would. Okay, I'm going to give him the benefit of the doubt
because he believes in the conviction of his policy to the level that he discounts other data. Or is he just a coward?
Listen, I have kept us on a time schedule on this podcast. Okay. You know, I want to come in and you got to throw around one of these big ones where we have to debate the entire history of Powell. I'm passing. Okay. I'm passing, and we'll discuss it more next week. Listen, anything else on Jackson Hole?
Again, I don't think Jay Powell is a coward. I think he can be cowardly in his messaging because he always tries to paint the mid way too much. Be a leader, give us your opinion, talk to us about the path of policy that you're anchoring against, and stop just punting every single time. He's punted for a year. And I don't criticize him on the pause. I think it was extremely important to have a prolonged pause. I talked about that a year and a half ago. Go into a pause it for a year, don't say anything. I don't have any critical thoughts about the pause. It's how he describes the pause. Why do you feel the need to always be data dependency in the pause? No. A year ago, you said we're pausing and we're going to pause for a long time until we're a little bit more confident on the path of policy. I don't know. It's going to be interesting, but again, we'll see what he has to say.
Yeah, we'll break it down.
Very quickly. I know we're on time here. Very quickly, the 24 Jackson Hole agenda is 4 bullet points here. Number 1, they're going to be talking about the effective use of monetary policy tools in the modern era.
I like traditional. Quantitative easing went from unconventional to now a traditional.
I'm very interested in what is unconventional monetary policy tools as of right now, because if they start laying out some unconventional stuff that is non-QE, I'm like, ooh, is this a Ben Bernanke moment type thing? Number 2, transmission mechanisms for how to understand the impact of inflation, economic growth, employment. That's going to be a lot of boring professor type speeches there. Inflation control amidst economic growth. How do we control inflation and get economic growth? It's almost like the central banks have not been doing this.
Have every year be a presidential election and have them manipulate the data. That's how you do
that should be one of the bullet points. And then the last one is digital currencies and financial innovation. Obviously talking about crypto and digital currencies out there as well. So I'm a nerd when it comes to the central bank. I geek out on this stuff. The only important speech out of the symposium this week is Jay Powell's on Friday morning.
Yeah, listen, we're going to break it all down, whatever the market activity. It is a nice setup for bulls heading into this week. Very little going on, and then the stuff that is concise allows moving averages to catch up. We are going to detail this and tackle today in our trading lounges every day during the week, so check us out. And if you're not a pro member, give us a shot, because you can check us out on Tackle Today during the course of the week, but we have really in-depth conversations in our Traders Lounge beginning 2 weeks ago. While markets were cracking, we delivered a very concise, actionable message of not to panic here. Don't do the things that you shouldn't be doing. All right, it was a good time. Be a pro member. It's good advice, but we do that every day. We do that every day for our pro members. Go to tackletrading.com, sign up for a 15-day free trial. And if you're watching like this, spread the word, hit like, share, do all of that stuff. Help us out. Matt, give us some final thoughts. Send us out.
Yeah, thank you so much for watching the Trading Justice podcast, and thank you so much for being the best part of our Trading Justice tackle trading community. If you like the podcast, tell somebody about it. Give us a nice little like and share, and we hope you have a wonderful, wonderful week in the market. And if you need anything from us at Tackle Trading, you can email us at team@tackletrading.com, or you can hit us up in our Tackle Trading Discord, or the billion different ways you can get a hold of somebody in America today. With that said, I hope everybody truly has a wonderful, wonderful week.